Hello and welcome to CIPS Level 2 Certificate in Procurement and Supply Operations. This is a revision session for Module 2, which is Procurement and Supply Operations. And we're looking at Learning Outcome 3 today, which is to understand the sources of information on suppliers and customers. So before approving a supply, you need to find out as much as you can about the organisation. And we can use internet search engines to do this. There are some that are multilingual search engines like Google and Yahoo, and some that use single languages. So you need to consider why it's important to take into consideration the impact that certain things will have on the buyer. So for example, does the supplier have capacity? That is the machinery, the staff, skills to meet the requirements. What are the supplier's environmental or CSR policies, and how much pollution do they create? Do they dispose of their waste correctly? Is the supplier financially stable? How are they performing? What's their credit rating look like? And where are they located? Can the supplier manage the logistics of delivering the goods to where you're located? And do they have a good reputation? Are there any rumours about the supplier that needs to be investigated? More reputable businesses will have their own website. On it, they will include information about their organisation, like their contact details, where they're located, maybe an introduction or a what's about our organisation section, what the business buys or sells, any branding such as logos and slogans, and links to their social media accounts. And finally, a contact form, which enables that contact details to be submitted seamlessly. So go and have a search of a supplier that you know, and just see how much of that information you can glean from the internet. We're now going to look at some of these terms. So the first one is B2B, which stands for business to business. This is used when we're talking about commercial transactions where businesses sell to other businesses, but it's not the end consumer. B2C, on the other hand, is business to customer, and that's when you're talking about retail transactions. E-commerce refers to all business conducted and paid for using the internet. And the term covers all the transactions such as sending electronic requisitions, requests for quotes and tenders, electronic authorization of documents through e-signatures, and receiving goods electronically, like downloads. And BACS stands for Bankers Automated Clearing Service, which is electronic transfer of funds from the buyer's account to the seller's account. So do you think the same laws apply to e-commerce as to standard contracts, or are they different? Let's look at some scenarios. A chair manufacturer purchases fabric from a textiles manufacturer and then sends an electronic funds transfer from their account to the seller. A customer buys a chair from a shop and pays with a credit card. And the chair manufacturer issues an RFQ to some logistics organisations. Now, credit rating agencies are impartial bodies that hold information about businesses and customers, such as credit limits within organisations, their trading history, as well as payment history, any turnover, profit and loss statements, shareholder funds, and if they've ever been subjected to a county court judgment. Now, these credit rating agencies give a credit rating score to any organisation, and that score indicates the amount of risk the debtor poses to the creditor. The debtor is the person who owes the money, the creditor the person who is owed the money. Now, different credit rating agencies use different scales, but these agencies use data from an organisation's own website or from public sector organisations such as Companies House in the UK and maybe Companies Registry in Hong Kong. The information held by these company registers do differ from one country to another, but they generally include basic information about the company, the nature of the business, such as if they're a retailer or a manufacturer, The status as to whether they're actively trading or dissolved. Financial reports. Current and resigned officers. Anybody that's been disqualified. If they've had a previous name, and whether or not the company has ever been insolvent. In other words, if they were unable to pay the money they owed. Now, credit rating agencies use all this information to evaluate the financial position of an organisation and assign a rating that shows how likely an organisation is to be able to afford to pay their debts in a timely way without defaulting. So what does a high credit rating score indicate? And what can a low credit rating indicate? So generally speaking, the higher the score, the better. The lower the score is almost a difficult situation, but it doesn't always mean that they've got bad debt. It could just be that they're a new company that's never filed any statements yet, so hasn't got any history. Now, do remember, credit rating agencies do not make decisions on behalf of your organisation. They simply supply you with a score so that your business can make an informed decision about whether to work with the buyer or supplier. So go to a credit rating agency's website and find out more information about credit rating scores. Find out at least 3 pieces of information to share with your colleagues just to see how that works. So we're now going to look at publications on individual organisation and markets. So on the left, we've got a balance sheet, and on the right, we have a cash flow statement. So which of these documents gives the best indicator of an organisation's financial health? Now, these market publications contain general information about how a particular area of the company and the economy is performing financially. The stock exchange notes general market trends, and other publications that focus on specific markets, for example, the London Metal Exchange, is a global centre for trading metals and publishes information about that market only. We're now going to look at the systems for purchase ordering. Now, materials requirement planning systems, or MRP systems, are often used to place purchase orders. Now, MRP's objectives is to ensure that all the parts or materials needed for manufacturing the end product is available. To plan production, establish when to place orders and schedule deliveries. They keep inventory value as low as possible. But the MRP PO process starts with the sales team entering an order. The MRP system refers to the current stock levels and calculates how many of each product is needed to be manufactured. The MRP then refers to the minimum order quantities and batch quantities, and also the buffer stocks to arrive at an order, and creates what's known as a bill of materials, or a BOM. The buyer uses the BOM to create purchase orders. Now, most purchase orders are sent electronically, but some are still sent manually. But these orders need to be kept in a file for checking purposes when goods are being received, and in case the business has an audit. Procurement teams need to capture data on expenditure in order to monitor how much has been spent and how much budget there is left to spend. But why do we need budgets? It's so everyone knows how much they have to spend and can make decisions based on what serves the company's needs. Now, the graph you're looking at now shows annual budgets versus actual spend. So have a look, which department has overspent their budget? Design, correct. If this graph shows the status halfway through a year, which departments are on track for their budget? Probably administration. And can you think of reasons why sales and marketing might not have spent as much this year? Is it the selling period that hasn't happened yet? A staff shortage has resulted in less work being done? Fewer campaigns? What impact could the latter have? So if we don't spend more on campaigns, it could potentially reduce the sales. Now, organisations use portals, which are usually on the internet, to bring information from various sources together. Supplier portals are set up by organisations to enable suppliers to apply to work with them. The portal may contain the following information about an organisation, such as overview and what it produces, a structure, definitions of direct and indirect supply, environmental and CSR policies, ordering processes, payment terms, a supplier handbook, confidentiality agreement, standards that are required, process improvement techniques, and shipping. Customer portals are used by buyers. Customer portals can be like a B2C, like an Amazon, business to consumer, or a business to business, B2B. A B2B portal contains information about the customer, such as their personal details, including their address, price lists, quotations, order history, invoices, any available credit, and the contracts. Each customer has login information to their own area of the website to ensure their details are secure. A supplier database is a collection of information about suppliers. It can be as simple as a list of suppliers an organisation works with. More complex databases can pre-qualify suppliers to achieve and receive an invitation to tender. Let's have a look at that flowchart. Let's outline the decisions made by suppliers database as part of that selection process. Decisions generally are the triangles. Well, not triangles, they're more like diamonds actually, sideways diamonds. So first one is whether it's compliant, yes or no. If it's a no, it gets rejected. Then you evaluate and ask yourself whether you should shortlist it. And that can happen at 2 stages if you're doing a 2-staged tender. And then last but not least, right at the very end, whether it's a preferred supplier, yes or no. And that's the end of Learning Outcome 3. Thanks for watching.